Everything looks fine. The indexes are near all-time highs. Corporate earnings reports continue to beat analyst expectations quarter after quarter. Financial television runs optimistic segments about economic resilience, the strength of consumer spending, and the durability of the current expansion. Every major bank publishes research telling its clients that current valuations are justified and that the bull market has plenty of runway ahead. This is exactly what it looked and sounded like in the months before 2007 collapsed into 2008. Michael Burry does not watch financial television. He reads the filings. He reads the prospectuses. He reads the footnotes buried so deep inside regulatory documents that no broadcast segment ever reaches them. What Burry has consistently identified, across multiple market cycles and multiple asset classes over the past 2 decades, is a specific set of signals that appear before every major collapse. These signals are present in public documents. They are hiding in plain sight, and the institutional consensus has every structural and financial incentive to ignore them until the damage is already done. Today, we examine exactly those signals. We trace how Burry identified them, what the historical record says about their predictive power, why they are being dismissed in the current environment, and what this means for every investor still relying on the headline rather than the primary source. Michael Burry is not a product of Wall Street. He is a former medical doctor from California who taught himself investing by reading every financial document he could access, spending hours each day analyzing companies while completing his medical training. He began publishing his investment analysis on an internet forum in the late 1990s, while still in residency. The quality of his thinking attracted institutional capital, and by 2001, Burry had founded Scion Capital. By 2004, he was doing something that virtually no institutional analyst on Wall Street was doing. He was reading mortgage prospectuses, not the summaries, not the ratings agency reports, the actual documents, every page, every clause, every disclosure buried in the fine print. Inside those documents, Burry found what nobody wanted to find. The American mortgage market was structurally broken. The loans were constructed to generate fees at origination with little regard for their long-term performance. The securities built on top of those loans were priced as if the underlying assets were sound. Nobody was checking the underlying assets. Burry checked. He built a short position against the housing market of over $1 billion at a time when that trade had zero institutional support, zero consensus validation, and zero mainstream financial coverage. By 2008, Scion Capital had generated returns of 489% for its investors, while the global financial system collapsed. The reason this history matters is not the size of the profit. It is the method. Burry identified the collapse through signals that were visible in public documents to any analyst willing to read them carefully. That same method is what we are applying today. The first signal Burry has repeatedly documented is what his framework treats as the euphoria indicator. Burry has argued that the most reliable precursor to a major market failure is not a technical metric or a single economic number. It is a behavioral state. When the majority of market participants collectively stop asking whether something can go wrong and begin operating as if nothing will go wrong, the structural conditions for catastrophic failure are already accumulating beneath the surface. One of the most direct measurements Burry points to is margin debt. When investors borrow aggressively against their existing portfolios to purchase additional assets, they are demonstrating a level of certainty about the future that has historically been a reliable signal of collective overextension. According to Burry's analysis, margin debt at record levels is not evidence of a healthy market. It is evidence of a market that has begun pricing in only one possible outcome. The consequence is architectural. When the reversal begins, margin calls do not allow patience. They force immediate liquidation into a falling market. Each forced sale pushes prices lower. Lower prices trigger additional margin calls on other leveraged positions. Those calls trigger additional forced sales. The self-reinforcing mechanism that Burry identified in the collapse of mortgage-backed securities in 2008 operates with identical arithmetic in leveraged equity markets. The debt does not create the underlying weakness. It is the accelerant that transforms a correction into a collapse. Beyond margin debt, Burry has pointed to the behavioral pattern of retail investor participation at cycle peaks as a compounding signal. Historically, the final phase of a speculative cycle draws in the broadest possible base of retail participants who enter markets at elevated prices driven by recent returns and social proof rather than fundamental analysis. Burry has observed that the proliferation of investment content on social media, the gamification of brokerage applications, and the normalization of speculative options trading among non-professional participants are behavioral markers that parallel the consumer participation in mortgage products in the years before 2008. This is not a demographic judgment. It is a structural observation. When the population of participants least likely to model the downside is the fastest-growing segment of the market, the behavioral conditions for a sharp and disorderly correction are in place. The second signal Burry has documented is credit spread compression. Credit spreads represent the difference in yield between risk-free government debt and riskier corporate bonds. When markets are functioning with appropriate caution, investors demand a meaningful premium for accepting the possibility of default. When spreads compress toward historic lows, investors are accepting minimal compensation for substantial risk. Burry's research shows that dramatic credit spread compression has been a consistent feature of late-cycle markets in the period immediately preceding major corrections. In 2006 and into the early months of 2007, spreads across investment-grade and high-yield bond markets compressed to levels that effectively priced out any meaningful probability of default across the corporate sector. The market had concluded that credit risk had been solved, redistributed, and engineered away by the financial system. Burry's reading of the underlying documents told a different story. The risk had not been eliminated. It had been repackaged into instruments that obscured its true concentration and magnitude behind layers of financial structuring. The compression of spreads was not a measurement of actual safety in the system. It was a measurement of the collective willingness to stop examining what the underlying risk actually looked like beneath the label printed on the security. The third signal is the one Burry has made most central to his recent public analysis: the structural distortion created by the explosive growth of passive investing. Burry published his argument on this mechanism beginning in 2019, drawing a deliberate parallel to the distortions he had identified in mortgage securities a decade earlier. The mechanics are specific. As capital has migrated from active stock picking to index funds and exchange-traded funds, the pricing mechanism of individual equity securities has been progressively replaced by mechanical capital distribution. When a dollar enters an index fund, it does not evaluate which companies deserve investment based on their earnings, their competitive position, or their valuation. It distributes automatically according to market capitalization weighting. The largest companies receive the largest allocations regardless of fundamental merit. According to Burry, this removes price discovery from the market. Price discovery is the process through which the collective judgment of informed buyers and sellers produces prices that reflect actual fundamental value. When that process is replaced by passive mechanical inflows, prices rise not because value is being created, but because capital is being distributed by formula. Burry has described the resulting liquidity illusion in precise terms. The funds appear to offer daily liquidity because they trade on exchanges. But the stocks inside those funds, particularly in the small and mid-cap range, have daily trading volumes that are a fraction of the fund assets built on top of them. The day a sufficient portion of passive investors decide simultaneously to exit, the underlying stocks will find no buyers at prices anywhere near current levels. According to Burry's analysis, this is not speculation. It is the arithmetic consequence of the structure. The fourth signal is the expansion of zombie companies. Following the 2008 crisis, central bank policy maintained interest rates at historically low levels across an extended period. The consequence that Burry and other value-oriented analysts have identified is that a substantial population of companies survived not because their operations generated sufficient cash flow to service their obligations, but because the cost of debt had been artificially suppressed. These companies exist in a state of deferred insolvency. They cannot generate enough cash to cover interest expense at normalized rates. They survive by continuously rolling short-term debt into new instruments at rates that historically would not have been available to issuers with their fundamental profiles. Burry's argument is that this population represents a decade or more of accumulated financial fragility that does not appear in any single company's earnings report. The companies appear in employment statistics. They appear in index fund holdings. They appear to function. But according to Burry's framework, they are not economically viable entities at rates that reflect genuine time preference and genuine credit risk. When the refinancing window closes and elevated rates persist, these companies fail in clusters. Not gradually, in clusters, because they are all dependent on the same artificial conditions. And when those conditions shift, they shift simultaneously for the entire cohort. The fifth signal is the disconnection of valuations from long-term historical norms. Burry's entire investment framework descends from Benjamin Graham, who established the principle that the price paid for any asset is the primary determinant of the return that asset will eventually produce. When prices disconnect significantly from fundamental measures of earnings power, the probability-weighted forward return falls and the downside risk increases proportionally. Cyclically adjusted price-to-earnings ratios, which measure valuations by smoothing earnings over a full economic cycle to remove distortions from short-term conditions, have reached levels that have historically preceded the lowest long-term return periods ever recorded for equity investors. Burry has been explicit that valuation signals do not predict timing. An expensive market can remain expensive for years. What the valuation signal predicts is the range of probable outcomes. When prices are historically elevated, the distribution of probable future outcomes skews sharply toward loss. The signal matters not because it identifies the date of the collapse, but because it measures the distance the market would need to travel to return to conditions that have historically supported sustainable capital preservation and growth. The application of Burry's signal framework is not a formula for market timing, and Burry himself has emphasized this distinction throughout his career. The purpose of identifying these signals is to understand what the structural risk landscape looks like before the consensus recognizes it, enabling a rational investor to adjust risk positioning accordingly. The first application is what Burry's methodology treats as liquidity mapping. Before entering any position, the question is not what happens in the best case. The question is, what happens to the exit when everyone wants to leave simultaneously? If that exit is acceptable, the position is acceptable. If it is not, the position must be sized or avoided entirely. The second application is primary source verification. Every investment product, every security, and every fund carries documents that describe exactly what the investor is buying and what the conditions of exit are. Burry's career is a demonstration that investors who read those documents have a structural information advantage over those who rely exclusively on summaries. The third application is independent conviction. Burry held his short position against the housing market through 2 years of institutional pressure, investor redemptions, and market movements that appeared to disprove his thesis. The signals had not changed. The fundamentals had not improved. The consensus simply had not yet arrived at the conclusion the data required. Beyond these 3 applications, Burry's framework includes a specific approach to time horizon that most institutional investors cannot replicate. Burry is not managing a quarterly earnings narrative. He is not subject to the benchmark anxiety that forces institutional managers to stay close to consensus positioning, regardless of their private views. This structural freedom allows him to take positions that may appear wrong for extended periods while the thesis develops. For individual investors, the equivalent freedom is the absence of professional career risk attached to the position. An individual investor who has done the primary source work and reached a conclusion based on the documents, does not face the institutional pressure that silenced every analyst who privately shared Burry's concerns about mortgage securities in 2006. That independence, which Burry has described as both his greatest advantage and his greatest isolation, is available to anyone willing to do the work. Today we have examined the 5 market signals that Michael Burry has documented across multiple research cycles. The euphoria indicator measured through leverage and behavioral overextension. The credit spread compression that signals the breakdown of risk pricing across the corporate sector. The liquidity illusion embedded in the passive investing structure and the removal of price discovery from equity markets. The hidden fragility of the zombie company sector built on a decade of artificial credit conditions, and the valuation disconnection that measures the scale of the eventual repricing when the catalyst finally arrives. Burry's work does not offer comfort. It offers clarity. The signals he has spent his career identifying are not locked in proprietary systems or restricted databases. They are available in public filings to any investor willing to read them with the same discipline Burry applies. The question his framework leaves for every investor watching is the one he has returned to throughout his public analysis. Are you reading the documents? Are you modeling the exits? Are you thinking independently of the consensus? The history of financial markets suggests these questions matter most at exactly the moment when almost nobody is asking them. Thank you for watching.